Good morning, everyone. Welcome to BodhiBrew, offering advantage through insight. I am your host, Ranjan Biduri, founder and CEO of Bodhi Research Group. Today's episode covers elite investor rules. We will be joined by Lawrence Evans, the director of Salomon Partners and an experienced investment coach, as well as Pierre-Philippe Ste-Marie, our managing director of investment research. Together, they will discuss what separates high performance from complacency in the world of investing and distinguishing luck from skill. Lawrence Evans is a performance coach with over 18 years of experience working with some of the world's largest institutional investors and hedge fund managers. So sit back, relax, and enjoy a cup of brew with us.
Good morning, everyone. Welcome to BodhiBrew. My name is Pierre-Philippe Ste-Marie. I am Managing Director, Investment Research with the Bodhi Research Group. Today, we welcome Lawrence Evans, Investment Coach at Salomon Partners. Lawrence, welcome to BodhiBrew. Thank you for traveling from Provence to meet with us today. We're discussing investment coaching and the rules of elite investment professionals. You're not a psychologist or a life coach for an investor, right?
No, I'm not an instructor. I won't tell investors how to run money. I'm not a shrink. I don't care if your mum and dad locked you up in a cupboard when you were 7 years old. I'm not a professor. There's no exams after the coaching I do.
So what are the key questions you focus on?
The principal questions are around skill and the definition of skill for the investor. Skill, unfortunately, is poorly defined in investing. Most people associate skill with near-term return. And unfortunately, skill in any other performance field has to be something you control.
So you mean skills associated with the fact that people are making money? You're looking at the results, they're resulting.
Yes.
Okay.
That is not skill. Why principally is skill not near-term return? The reason it's not is because luck, whether we like to realize it or not, plays an enormous role.
Mm-hmm.
And in any investment anybody makes, we are often right for the wrong reasons or wrong for the right reasons. And yet the industry has overlooked that for many years, and it's a comfort zone. It's easy to measure, but not necessarily the most important thing to understand.
I'm just curious, is there a way to quantify how much luck plays a role in institutional investing?
Every performance activity has a combination of skill and luck. Let me give you an example. Think of it like perhaps a continuum, where at one end of the scale you have an activity whose outcome is totally dominated by luck. So, for example, playing roulette. That's a proxy for all luck. Take the other end of a continuum where you have an activity whose outcome is almost totally dominated by skill. For instance, a grandmaster of chess.
Okay.
So you have a continuum. The question that I was keen and I'm still fascinated by is where on that continuum would an investment team or an individual investor sit? And how would I find out? And that was something I wrestled with for a long time. And I was getting nowhere until I asked help from my former physics professors. And they said, look, whilst we don't understand investing, we'll give it some thought. And they came back sometime later with a very interesting statement, which said, if you can deliberately lose at any given activity, it is by definition majority skill. And, of course, could Rafael Nadal have deliberately lost a French Open final? Of course. He just served long or hit a forehand long or wide.
Yeah.
And yet, if we buy a lottery ticket or if we play a game of roulette, whilst we'll statistically lose, we can't guarantee losing.
That's right.
And so I thought that was interesting. And so one of the first clients I ever had, which was a blue-blooded British asset management niche company, I had their team in a room and I asked them a question. I said, if we assume I give you a benchmark called the FTSE 250, and we assume spreads are thin and commissions are zero, over the period of, let's say, 1 year, could you deliberately underperform that benchmark? And their response was fascinating. They initially responded with a violent, yes, we just buy bad stocks.
Yep.
But soon arguments broke out between the group, only stopped by the CIO, who concluded what he's asked is, can you deliberately lose? And what he said is, which is exactly the same thing as saying, can you deliberately win? Only the other way around. And they had 9 years worth of data to prove they could not do that. So on that morning, they learned that they were majority luck. And so the point being is that whilst you can have majority skill, it's rare.
Mm-hmm.
But the point is, in my coaching, I can't prove this, I don't believe I've ever met an investor north of probably 55% skill relative to luck. And most investors are some way lower than that. And
Wow.
so as part of the skill equation, what one is trying to do is increase skill at the expense of luck.
Yes.
So hopefully that gives you an example of where the industry sits relative to structurally, for instance, the game of tennis at a professional level, which is more like 80%, if I was guessing, skill and 20% luck.
Got it.
So from my perspective, the industry sits with many comfort zones, one of which is the definition of skill. There are at least several others, but two I will comment on. One is the industry generally doesn't value self-awareness and doesn't sponsor self-awareness. The example being that human beings are irrational. All of us have patterns of irrationality, often called behavioral biases. The poster child of the behavioral bias world is called loss aversion. And loss aversion suggests that human beings hate losing 2.5 times more than they enjoy winning.
And how did that number come about, 2.5 times?
Work done by Daniel Kahneman.
Okay.
And that suggests that...
the author of Judgment Under Heuristics and Biases. Okay.
That suggests that a 10% loss feels 2.5 times as bad as a 10% gain feels good.
Okay.
And that's one of 150 or so that have been individually identified. And yet, when I ask a professional discretionary investor typically what work they have done to better understand their own likely rank order of behavioral biases that they have as a unique human, they normally look at me relatively blankly. So I think that is a huge...
Because they haven't thought about that.
Well, the industry doesn't sponsor it.
Mm-hmm.
Because they're coming back to the fact that it sponsors everything around near-term outcomes.
That's right.
And if you produce near-term outcomes, the default is that is skill.
Mm-hmm.
But skill, to repeat myself, has to be in any other performance vertical something you control. In golf, it is the swing. In swimming, it is the swimming action. It's not necessarily your competitor's action. It has to be something you control. And so that is a big comfort zone issue. Another question I ask of investors is, in the world of performance, to get to world number one, you have to do a minimum of two things. One is you have to compete, and the hedge fund world and institutional world very much understand that competition is important.
Absolutely.
The second component that is a non-negotiable in the world of elite performance is you have to practice.
That's right.
And yet, when I ask, or we ask CIOs or senior investors, could you share with me how you sponsor practice in your team or sponsor practice on the platform? Again, I'm met with vague looks.
Absolutely. Like, what do you mean by practice?
Well, practice is all about reflection. Practice, simply put, is a feedback loop. And most people, when they, for instance, buy something and it works, they assume that was skillful. But on many occasions, we can all be right on an outcome for many, many wrong reasons.
Yes.
And very few people understand or religiously have a mechanism to have a reflection or post-mortem on all positions above a certain size, for example.
Mm-hmm.
And it's not a complex procedure, it's a discipline procedure. But again, explicit discipline in this industry is not well sponsored.
Interesting. So by practice, you mean being able to analyze the trade post-mortem after?
Yeah, and essentially practice is an audit trail of your decisions that you self-sufficiently capture. And
it's not fake trades.
No, it's real trades that you did. And finding patterns in that audit that you think may be causal. If they are causal, then perhaps with enough data, it can cause you to change part of your process or update part of your process.
Absolutely. So if skill isn't near-term returns and the industry is perhaps somewhat inefficient, what definition of skill do you think is appropriate?
So in order to do what I do, which is coach, to develop skill, which is the objective of what I do, you have to define skill.
Mm.
And whilst I don't believe that I've come up with a new form of Einstein's energy and mass equivalence, I do have a hypothesis of an equation. And I believe that it's totally within the control of an investor, what I'm about to say. And I believe all investors control how do they get from a potential universe of names in a portfolio which is this wide down to their actual selected portfolio which is this wide. I believe that is a distillation, and that is what I call rules. And there are three kinds of rules. There are buying rules, there are selling rules, and there are sizing rules. The three activities that every investor practices. And I believe those are totally within an investor's control. So skill, in the first part of the equation, I believe is the rule sets. How clear is the investor on their own rules at any given time? However, skill is rules could be described as a quant strategy, because all an algorithm is a set of rules.
Yeah, exactly.
And so the reason I tend not to coach quant funds is because broadly many quant funds write rules, but they don't update those rules dynamically fast enough, so the rules are right until they're wrong.
Interesting. Very cool.
And so for an active discretionary investor, I believe the equation needs to be slightly adapted. And I think the skill equation that they control is skill is the rules to buy and sell and size at any time, plus how do they systematically have an explicit mechanism to decide if those rules are still fit for purpose given a changing macro or micro landscape. And that feedback engine, which we touched on earlier, is practice. But most people, whilst they have it in their heads as an implicit feedback loop, given the behavioral biases of the human, it needs to be explicit. And that is part of what I help investors construct.
This explicit set of rules that fits an investment philosophy, that fits...
So investors have to believe clearly, and it's probably non-changing, what they specifically think is inefficient in their universe.
Okay.
But with emphasis on the word specifically. Most investment philosophies I see are very generic. They are not differentiated, and they don't tend to be unique. And not only do they have to be very specific about what they believe is inefficient, they also have to convince the allocator, do they have the awareness of who they are as a character to convince the allocator that they are likely to be able to exploit those specific inefficiencies.
Does the investor know themselves who they are, and that has to be shown within the investment philosophy?
Yes, and
so it's this alloy between understanding the weakness in the market that you're exploiting and linking it to who you truly are.
Yes. And the way we do that is they're not perfect, but through psychometric assessment. And I happen to use two. One is called the Strengths Finder profile from the Gallup organization.
Yes.
Which you know well.
Yeah, we've completed it, and I'd love to go briefly over it.
The second I use is a psychometric assessment called the Risk Type Compass. And both are dealing with personality, and both effectively say that your personality, when you get to maybe early adulthood, is broadly fully formed.
Okay.
And think of it like a hand of cards that is face down on the table. But most investors are not trained and they're not supported to be able to turn those cards over.
So that's what you provide. You provide the ability to at least look at the cards that you've been given.
Again, it's almost like a jigsaw puzzle that will never be complete.
Okay.
We will never get to a perfect picture for the individual, but I fundamentally believe that self-awareness is at the heart of all performance activity, with zero exception. And I also happen to believe that of the multiple thousands of investors I've coached throughout a career, one of the two key causal factors in those elite investors are colossal and ongoing self-awareness on what they're good at, to do more of it, and perhaps where they're weak and to do less of it.
That's insightful. So focus on your strength.
Yeah, and we talked earlier, Pierre, about the fact that a great story of late was that a client of mine asked me about his eldest daughter, who'd had her first proper school report where she had all A grades and 1 D. And he decided to help his daughter with a personal tutor in the D grade. And he asked me, did I think, as a performance coach, he did the right thing? And my question to him was, I think you did perhaps the wrong thing, on the basis that what a performance coach might suggest is what was your daughter in the A grades most passionate about, and found easy. And rather than fixing the D grades, what a performance coach might suggest is getting a personal tutor in the strongest A grades. So it's about strength maximization rather than weakness mitigation. And that is a concept that is alien to many, but I feel in investing is at the heart of elite investors.
Yeah. Also, it's linked to Peter Drucker principle of that's great. That's amazing. That's also insightful for investors. Focus on your strength. Focus on what you're good at. And in order to do this, you really need to understand what are your strengths. So every work you do is under NDA with every single investor, so you can't talk about that. But we ran the Strength Finder on myself.
Yes.
Could you share briefly the results? Like, what would that provide as an insight, as an example?
At a very high level, Pierre, as we briefly discussed earlier, the Strengths Finder ranks your strengths and everybody's strengths from their greatest strength in the world at number 1, all the way down in rank order to number 34, theoretically, your least greatest strength in the world. And with the prior comment, the logic is to, in your job as an investor, do more of where your top 7 or 8 strengths in your day job, and don't necessarily try and leverage your 34 through 29. And in your case, what I found very interesting was that your profile is very top-heavy in deeply thoughtful themes, meaning deeply strategically interested in joining the dots in the way you think, but with one very specific theme, which is the way you tend to do so is with a very historical context. Okay. And so what it says immediately from a brief look at your profile is that every decision you make on an investment is based on having to understand the case study of this investment, going deep, but also in your profile, there are themes linked to being much more comfortable one-on-one rather than in large groups of people. And if that is indeed true, this might lead us to think about your investing style as one of looking for core names through a deep strategic dive, using history to understand those likely names.
So mostly more concentrated positions.
In the higher confidence positions where you have done a deep dive, which only may be perhaps once or twice a year.
Okay.
And again, that's not to say that that's a scientific proof, but that would be an example of the way we might explore your investing process linked to who you are.
That's very interesting. Providing data, providing insight into who a person is and how that impact their investments, that's insightful. That's very useful for an investor.
And if we think about artificial intelligence and its role, the clue's in the title, intelligence.
Mm-hmm.
And the more intelligent LLMs become, the more classic information and knowledge and classic analytical work becomes commoditized, leaving active discretionary investors that perhaps the most important thing that the future will hold is who they are as a personality, how they are unique, how they can leverage those specific strengths. And I think that will become increasingly important in the future of active management.
Those who know who they are will be able to outperform the machines.
I think there will be a place for them to generate a fee from allocators of capital that trust their skill.
Nice. So you say you need to know who you are and you need to know your roles consciously. Does this tend to be universally accepted?
In most cases, investors find that rational and logical. I did have a situation relatively recently where a senior investor called me out and said in his situation that does not apply. He was the exception to that equation.
Of course he was.
I asked him to expand, and he said because the reason why the equation was incorrect was because he didn't have any rules. And I questioned him by saying, well, in fact, how do you invest? And he said, well, everything I do is feel, it's instinct. Mm-hmm. If it feels right, I do it. If it doesn't feel right, I don't do it. So I said, do you mind if I cross-examine that? And he said, okay. And he was there with his team. And my first question was, in the world of equity long-short, are there any sectors or areas that you will allow or not allow yourself to invest in? Mm-hmm. His answer was, Lawrence, you clearly haven't listened to what I've said. If it feels right, I'll go long India. If it doesn't feel right, I'll go short Venezuela. I was about to move on to the second question when he said, other than, I will tell you, I'll never own biotech. At which point I write down rule number 1, no biotech. I proceed with Socratic-based questioning for the next 20 minutes in which he states a clear 7 rules around his process. His team was smirking. I stopped it after 20 minutes, turned the piece of paper round to illustrate the 7 rules he had suggested. He confirmed that he had in fact said those, and on that morning, well, he looked at me and said, what's wrong with me? and I said, welcome to the world of being human. And he is an extreme case of something I see all the time, which is that people have conscious and subconscious rules. He was just an extreme case of having no conscious rules and all subconscious rules.
Yeah.
So yes, it isn't universally loved, but it's yet to be disproved in 17 years of coaching.
And we'll end with this. Mm-hmm. Are there any common rules that a lead investor must have?
In the many thousands of investors I've coached, I've only managed to unearth 2 that appear valid across all.
Universal rules.
And they may not be what you'd expect, Pierre. The first is, one, the elite must be extraordinarily self-aware on who they are and have a hunger to know more and more about themselves, irrelevant of how many tens or hundreds of millions of dollars they have in the bank. The second is the use in their day-to-day processes of explicit tools to aid with execution discipline. Those 2, to me, are fundamental to all elite investors.
Well, thank you very much for your time today, Lawrence. It was a real pleasure talking to you. I certainly learned a lot about trading, and I've done it for a long time, so thank you.
Thank you for having me, and nice to be on a spring day in Toronto.